everybody, and welcome to the Fred Report Technical Market Call for October 13th, 2011. So you know, my associate Jeff Garvaz is not going to be on the call today, which means we'll probably have a little bit of a quicker call, which is good as I've got probably more meetings in the next 2 days than I have in any other 2-day period for the whole year. So with that, we'll get right into the call. And I guess the first thing I would say is so far the stock market is doing about what we thought it would do with that divergence bottom. It's shot up back up into the resistance area at 120 to 122. We noted in the midweek that the daily FPO hit plus 10 and the market is actually still up, and this is positive. We believe that that 122, 123 area can be penetrated without too much difficulty. We would like to see some consolidation here. And not a complete runaway market, but frankly, if it does run away, we're okay with that. The main thing here is we should not go down and penetrate that 108 area, say 1070 on the S&P. If if we do that, the idea that this is the low for the year is off. We think corrections are likely to be limited to 1 or 2 days and possibly 1 or 2%. We're a little more aggressive than some of the analysts at other firms, mind you, but we think that any down moves at all should be used to accumulate strong stocks in strong sectors. And while we're on that subject, we keep getting questions on the financials, and we did mention in our update at the lows of this thing that the financials would probably be good trading buys initially, but these stocks are still looking like big-time underperformers, and if you're trading them, do so at your peril. I'm not certain that these will lead into the end of the year. I'm not certain that they will even perform adequately at the end of the year. And at the same time, I look at stocks like IBM, which is only down a little bit today, and which actually yesterday has hit new highs for the 2007 to 2010, 11 period. The stock is trading extremely well. So I'm a little bit more interested in buying strong stocks in strong sectors than weaker stocks that are likely to bounce. The upshot of this is everything should work ultimately if we're right. We think this could be the low for the year in here that we just hit, and we're very excited about this market here and think that there's going to be some nice opportunities. We note, though, as again, short-term overbought, a little bit of correction, a little bit of sideways, we're okay. Let's talk a little bit about bonds and the TLT. We've gotten a lot of questions because the TLT basically went down through that 114 area we've been talking about, is now back above it. The daily moving averages on the TLT have gone negative really for the first time since July. But one of the questions we were asked by several people is, in terms of stop losses, how do you avoid setting a stop loss where you get run? And again, the question there is, that's a good question. The main thing here on this one, and this is at least partially my fault, was there were excellent technical reasons to look for 114 as a stop loss. If you've got an area like that people are talking about as a point that you cannot penetrate your stop, you're probably going to go there. So if you're going to try to stay with a position, you need to put the stop a little bit below that or enough above that. Now, we saw that on TLT. It just gapped right through the 115.90 area. One of the people said they had a stop in around 115.70. And the other method that I use for setting stops, aside from using weekly lows, is I do use the daily parabolic system for setting stops, and that may help. I will address that question in maybe in this week's newsletter. It's a good question, and when I was asked the question, I looked at it quickly, and I want to give that a little bit more. In terms of the TLT, though, we have tested that 114 area. We are currently above it. I'm still not really enthused with these bonds, folks, even though they're oversold here. Any rally to 118 that fails and then any subsequent new low below the low that we just made targets a move all the way back to 100 to 98. And as wild as that sounds, we may really see these things back at 100 to 108, especially when the market, if we're correct, starts to accelerate again. We've had some questions on gold. I think gold is probably a buy here. This next pullback, if we can get to 157.50 on GLD, I would add the positions there again. We may not get there. You're seeing a situation where your daily moving averages are probably going to try to go positive in the next few sessions. The stochastic is overbought, and the short-term SPO on gold is overbought. But a little bit of correction there is fine. We note that commodities in general are approaching the seasonal time where you get a run into the end of the year. And when I look at oil, for example, oil's had a nice little rally off the bottom. If I look at DBO, for example, I can see a move back to, say, 23.60 on that, or on USO, a move back to, say, 31.30, 32. And then anything above 35 on USO looks like we're going to gun it. And that could happen end of October into November, December. The other index we're looking at there, of course, is DBC, which on the weekly chart came right down and tested that 25 area. You've got a gap to fill at 28. If we fill that gap and start to go up, DBC could be back in the 30s. That's what normally happens November, December, January, and that's one of the reasons why we're also overweight the XLE here, which has been a little bit weaker than the market, but has the potential to be a good bit stronger November, December, January. We had an interesting question from one of our advisors on corn. Corn is seasonally weak into November, December, and that has been occurring. For those of you who are trading the agricultural stocks, note that corn and beans are almost always weak into December, January, February, whereas wheat peaks in there. So on some of the ETFs that have all of them in there, you have a tendency to get some conflicting news and behavior. But what we're looking at here is on, say, DBA, there is good support on DBA in the 28-29 area, which was tested. That's an agricultural ETF. JJG is another agricultural ETF. It's come down nicely. Support is actually a little bit lower, say 42 on that, and the low is around 42.30. And, of course, PAGG, which is stocks that are pertaining to agriculture, got way down, has snapped back up. Guys, if PAGG gets down into that 25.50 area, that's probably a good time to start legging in and realize that these are going to be good trades into summer. The classic commodity trade is the long July corn or long July soybeans and short November beans, with the idea being you have a spread and you're hedged. You take off the beans or corn at the peak in July, and you just remain short into November. So again, you're going to probably see some stuff come down in there, but after that occurs, you will probably see a nice run in the summer if the economy's improving, as we think it will be doing a little bit. And by the way, we're not in the we're going to have a new recession camp here. We may be wrong about this, but our thought is this is sort of a slowdown or pullback in an uptrend for the economy, which admittedly is sluggish. And as we move into summer and into part of next year, I think you're going to see things pick up a little bit. Not a huge amount, but a little bit. With that, we're going to go into some of the stock questions that we've had.